Welcome to Breaking News to Trading Moves. Right now the companies creating the artificial intelligence revolution, the ones building the actual intelligence, they're being punished by investors. But the companies building the air conditioners to cool their servers are making an absolute fortune.
Yeah, it's a perfect example of how financial markets price reality over theory. I
Hmm.
mean, investors are ignoring the futuristic promises and, well, just following the physical cash.
Right, exactly. And that is exactly what we are focusing on today. We're looking entirely at a new piece of research, the HPE AI Infrastructure Momentum Report, and giving you a breakdown of the specific winners and losers resulting from this news.
Yeah.
Because the core headline driving this discussion is really straightforward. Hewlett Packard Enterprise jumped after a very strong quarter. But, what is actually happening under the hood here?
Well, the report details a measurable reality in the market right now. AI infrastructure demand is translating into real, tangible server revenue. Like, we are no longer dealing with market hype or theoretical
Yeah.
projections.
Yeah, we're totally past the hype days.
Exactly. Reuters reported that Hewlett Packard Enterprise, HPE, saw its shares surge, and the company is actually on track to hit its long-term financial targets 2 full years ahead of schedule.
Yeah.
And that acceleration is entirely helped by the demand for AI servers used in data centers.
Which gives you a very clear takeaway, right? The AI trade is moving well beyond just the chip makers alone.
Absolutely.
Investors are actively rewarding companies supplying the full AI infrastructure stack. So we are talking about servers, networking, storage, memory, data center hardware, and the broader enterprise IT refresh cycles.
And that context is crucial for understanding the current market, because for the longest time, the spotlight was strictly on the companies designing the silicon.
Right, the chips.
Right. But a processor cannot function in a vacuum. It requires an extensive ecosystem to operate, to handle data and actually deliver an output to the end user. The money is visibly flowing into the hands of the companies building that hardware ecosystem.
So let's look at the first group of winners resulting from this news, the AI server and infrastructure suppliers. The companies mentioned here are Hewlett Packard Enterprise, HPE, Supermicrocomputer, SMCI, and Dell Technologies, DELL.
Yeah.
Now, I get the demand is high, but historically, when hardware makers try to gouge on price or charge massive premiums, enterprise buyers just delay their refresh cycles. Why aren't buyers calling their bluff this time?
Well, it's because the fear of missing out on AI capabilities is completely overriding standard enterprise procurement logic.
Oh, wow, really?
Yeah, in a traditional hardware cycle, exactly as you said. If prices get too high, a chief information officer will just delay upgrading the corporate servers, or they'll negotiate fiercely for volume discounts, which hurts the manufacturer's margins.
Right, they push back.
But right now, the need for compute power is so urgent that buyers are absorbing higher server prices without any major demand destruction.
They are essentially forced to take the price because if they don't buy the cluster today, their competitor buys it tomorrow, and they fall behind on training their models.
Precisely. The customers are accepting the higher costs. And this leads directly to stronger revenue, much better pricing power, and naturally improved investor sentiment for these specific server makers like HPE and Dell. They aren't viewed as legacy, low-margin box builders anymore. They are the gatekeepers to the compute power.
But let's follow that logic down the supply chain. If HPE and Dell are shipping more physical systems, they obviously need more parts to build them.
Exactly.
The report calls out the AI chip, networking, and memory suppliers as the next logical winners. So we are looking at NVIDIA, NVDA, Broadcom, AVGO, and Micron Technology, MU.
Yes, because the strength of AI server demand directly supports the demand for the components inside those exact systems.
Yeah.
So we're talking about GPUs, custom accelerators, networking chips, and high bandwidth memory. If the server makers are pushing more volume out the door, the component makers are riding that exact same trajectory.
I actually want to pause on that high bandwidth memory part, specifically regarding Micron MU. We hear constantly about the processors like the brains of the operation.
Yeah.
But I think people underestimate the bottleneck problem. It's like buying a Formula One engine, which is your GPU, but you hook it up to a golf cart fuel line, which is standard memory. The engine is just going to stall out because it can't get fuel fast enough.
That is a highly accurate way to visualize it. I mean, an AI processor is incredibly fast, but it can only calculate data as quickly as that data is fed into it. Standard memory creates a severe bottleneck.
So the expensive processor just sits there.
Yeah, it just sits idle, waiting for information to arrive. High bandwidth memory is the fire hose that actually lets that engine run at top speed. It is specifically designed and physically stacked closer to the processor to shuttle massive amounts of data back and forth instantly.
So as these servers become more advanced, the requirement for premium specialized memory scales up perfectly alongside them. The processor means nothing without the memory to feed it.
Right, and producing high bandwidth memory is technically difficult. That limits supply and gives companies like Micron excellent pricing power,
Mhm.
basically mirroring the dynamics we see with the server makers.
Right, so we have the physical servers and we have the premium parts inside them. But we have to address the physical reality of all this new hardware. You can't just take a brand new multi-million-dollar AI server cluster, wheel it into a standard utility closet in an office building, and plug it into a standard wall outlet. Where exactly are these going?
Right, that physical limitation creates our next category of winners, data center and power infrastructure. The report highlights Equinix, EQIX, Digital Realty Trust, DLR, and Vertiv Holdings, VRT.
This is where the sheer physics of AI really changes the game. We are not just talking about renting shelf space in a warehouse.
Not at all.
Yeah.
The growth in AI servers strictly increases the need for specialized data center capacity, power, cooling, and infrastructure management. I mean, think about the power density of these new systems.
Okay.
A traditional enterprise server rack might draw maybe 5 to 10 kilowatts of power. A single modern AI server rack can draw over 40 kilowatts.
Wait, 40 kilowatts? Which forces a total architectural change in how a building operates. If you are drawing 40 kilowatts of power into a single metal rack, you are generating a massive amount of heat. You literally cannot push enough chilled ambient air through a standard data center floor to cool that down.
Exactly. Standard air conditioning fails completely at that density.
Ah.
And if you run a server too hot, it throttles its performance to save itself. Or the silicon just physically degrades and breaks down entirely.
Oh, man.
This is why Vertiv Holdings, VRT, is on the winners list. They deal with advanced power and thermal management systems. Data centers are having to upgrade to liquid cooling systems, where specialized coolants are piped directly to the hot plates on the processors just to keep the hardware functional.
So a company buying an AI server also creates forced spending on real estate and plumbing.
Correct. And this directly supports companies tied to the actual data center real estate, like Equinix and Digital Realty Trust. Because they provide the physical footprint, the reinforced concrete floors needed to hold these heavier liquid-cooled racks and the massive electrical substation connections.
Wow, so it is a chain of forced physical upgrades. The demand for intelligence requires the server requires the memory, and the assembled unit requires a highly specialized industrial facility just to stop it from melting. And all of those links in the chain represent tangible, near-term revenue.
Yeah, which brings us to the other side of the ledger. Because capital is finite. A massive capital injection into physical AI servers doesn't just materialize out of thin air. Let's look at the losers category outlined in the report, starting with traditional IT hardware laggards.
The companies mentioned here facing pressure are HP Inc., HPQ, NetApp, NTAP, and Xerox XRX. Every dollar an enterprise pours into an AI server is a dollar quietly siphoned away from legacy hardware.
Yeah, this is a textbook market rotation. The report details that the HPE rally increases pressure on these legacy hardware names because they completely lack the AI infrastructure narrative.
Right.
Investors see a high-growth opportunity in AI hardware, so they fund those new investments by selling off their holdings in slower-growth traditional tech areas.
And just to be clear, HP Inc., HPQ, handles the PC and printer side of the business, which is completely separate from Hewlett Packard Enterprise. And it makes perfect sense why they, along with Xerox, are left behind.
Yeah, absolutely.
Because if a chief information officer has a strict annual IT budget and they are suddenly forced to spend twice as much on an AI server cluster this year to stay competitive, something else has to get cut.
The standard corporate refresh cycle gets delayed. The CIO decides the company can wait another 2 years to upgrade the office laptops, the printers, or the standard enterprise file storage. They divert those funds directly to the AI infrastructure budget.
So if your core business model relies on selling traditional office hardware, you are facing a severe contraction in enterprise spending.
Exactly.
Okay, so that logical zero-sum game makes sense for hardware, but the next group of losers in the report requires a bit more explanation. We are looking at software names with weaker direct AI infrastructure leverage. The specific companies mentioned are Salesforce, CRM, ServiceNow, NOW, and Adobe, ADBE.
Yeah.
Why aren't software companies winning instantly? I mean, software developers are the ones actually building the applications that make the AI useful to the consumer.
It comes down to the speed of monetization. The key phrase in this entire report is near-term revenue. The HPE rally highlights a strict market preference for companies where AI demand is showing up in tangible hardware orders today. You can track a physical server leaving a loading dock.
Right.
You can measure the invoice being paid immediately.
Hardware gets a lump sum payment today, but software relies on a slow trickle of subscription upgrades tomorrow.
Precisely. That creates relative pressure on software names because AI monetization is much harder to measure and much slower to realize in that space. I mean, enterprises treat AI servers as an immediate capital investment. They buy the box, they own the box,
Yeah.
but AI software is an operational expense.
Right. If a software as a service provider, a SaaS company, adds a generative AI assistant to their platform, they can't just instantly force all their clients to pay a 30% higher subscription fee.
They cannot. The enterprise adoption cycle for software is slow. You have to integrate the new API into your existing corporate workflows. You have to train your staff on how to use the new AI features without breaking your current systems.
Which takes forever in a big corporation.
It does. And most importantly, you have to prove the return on investment. The client wants to run a 6-month pilot program to see if the AI tool actually increases productivity before they agree to upgrade their entire corporate subscription tier.
And even then, the software company might have to wait for the client's current multi-year contract to expire before they can legally renew them at that higher rate.
Exactly. Investors are looking at these software companies and waiting for clear earnings acceleration. They know the tools are being built, but the actual cash hitting the balance sheet is lagging far behind the hardware makers.
So the market is impatient.
Highly impatient.
Yeah.
Right now, capital's flowing away from the companies trying to figure out how to charge for AI software and flowing directly toward the companies selling the physical metal.
That sets up the final category of losers in the report, and this is the finding that really highlights the bizarre financial mechanics of this moment. We are talking about big tech's capital expenditure burden. The major players driving the entire AI build-out are actually facing short-term downsides.
It sounds contradictory, but it's completely logical when you look at the balance sheets.
Yeah.
The big tech companies facing higher AI infrastructure costs mentioned here are Alphabet, GOGL, Meta Platforms, META, and Microsoft, MSFT.
Now, these are the pioneers. These are the companies building the massive foundation models that the entire industry relies on. How does the market view them as losers?
Well, you have to separate the long-term outlook from the short-term financial reality. These companies are undeniably major AI winners in the long term. They will control the foundation models that define computing for the next decade.
Sure.
But in the immediate term, they are losers from the cost side of the AI build-out.
Because they are the ultimate customers. They're the ones actually cutting the checks for all those expensive servers, the high bandwidth memory, and the liquid cooling systems we just talked about.
Exactly. Go back to our first point about the server makers like HPE gaining pricing power. The customers are absorbing those higher costs. Well, Alphabet, Meta, and Microsoft are those customers.
Oh, wow, yeah.
They are the cloud and platform providers footing these incredibly heavy capital expenditure bills.
So these cloud providers are dramatically ramping up their capital expenditures to secure this hardware. And when investors look at a quarterly earnings report from a company like Meta, META, they are obsessed with near-term free cash flow.
Completely obsessed.
They get incredibly nervous when management announces they're increasing their spending guidance by billions of dollars just to buy more infrastructure.
Because that is cash going out the door today to build specialized data centers rather than being returned to the shareholders in the form of stock buybacks or dividends.
Right.
Investors want high profit margins. The pricing power dynamic works entirely against big tech right now. If HPE and NVIDIA are pulling in record margins because they can charge a premium, that premium is a direct, unavoidable cost to Microsoft, MSFT, and Alphabet, GOGL.
The wealth is actively transferring from the balance sheets of big tech directly into the revenue streams of the hardware and infrastructure providers.
That's exactly what's happening.
Big tech really has no choice. They're placing a massive financial bet that these expenditures will eventually secure dominant market share down the road. But right now, it strictly depresses their free cash flow, which is why investors are treating them with so much caution.
The market operates as a closed system in this regard. Tracking where the capital is flowing provides a clear map of who holds the leverage. And right now, the leverage sits firmly with the companies building and supplying the physical infrastructure.
Which leaves you with a final thought to mull over based on the report. Consider the ongoing tension between these hardware makers charging premium prices and the big tech platforms forced to pay those bills to stay relevant. How long will the cloud and platform companies be willing to absorb these heavier capital expenditure costs before the pressure from their own shareholders forces them to pull back? That tension is going to define enterprise technology spending for the foreseeable future.
Thank you for joining the discussion.
This is not financial advice or buy or sell recommendations. This is purely the opinion of the author.